Valuing a company is one of the most important skills in finance, but what are the best ways to do it? In just 2 minutes, I'll break down 3 key valuation approaches: WACC, FTE, and APV. When valuing a business, the goal is to estimate the present value of its future cash flows. The weighted average cost of capital, or WACC approach, is one of the most commonly used methods. It calculates the value of a firm by discounting the free cash flows to the entire firm, both debt and equity holders, at the WACC. This reflects the average cost of financing from both equity and debt. WACC is especially useful when the company has a stable capital structure. Next is the free cash flow to equity, or FTE approach. This method focuses specifically on the cash flows available to equity investors after subtracting taxes, expenses, and debt repayments. These cash flows are discounted using the cost of equity, which is often estimated with the capital asset pricing model, or CAPM. CAPM takes into account the risk-free rate, the market risk premium, and the firm's beta, its sensitivity to market movements. The third method is the adjusted present value, or APV approach. It starts by calculating the value of the firm assuming it is entirely equity financed. Then, it adds the present value of tax shields generated by debt financing. These are typically based on the corporate tax rate and the firm's interest payments. APV is especially helpful when a firm's leverage is changing or uncertain, as it separates the value of operations from financing effects. Let's take an example. Imagine a company with stable cash flows, moderate debt, and a predictable capital structure. The WACC method would likely give a clear, reliable valuation, but if that same company were planning to take on significant debt, the APV method might better reflect the added value from interest tax shields. Each method has its strengths. WACC works well with stable financing. FTE is ideal when equity returns are the main focus. APV shines when debt levels are expected to shift. Thanks for watching another episode of Finance in 2 minutes. If you found this breakdown helpful, hit that subscribe button and keep learning with us. And do not forget to grab your free summary cheat sheet using the link in the description. See you in the next video!